Consider two companies, A and B, earning a net profit after tax of $1 million and $10 million respectively. Which company is better off? At first glance, it is tempting to say company B is better off. However, what if I tell you company A is a small company with only 1,000 shareholders and company B is a large company with 1 million shareholders? If you do the calculations, you will realize that on average, each shareholder of company A makes a profit of $1,000 and for company B, $10. Now it seems like company A is better off. Such financial indicators is useful to roughly gauge the shareholders' wealth. Big companies like Amazon or Microsoft earn billions of dollars of profit each year. $1 billion has 9 zeros, mind you. The numbers get too large that sometimes it is hard to truly appreciate how profitable the company is. To illustrate what I mean, if I tell you Amazon earned over $10 billion, what's your initial reaction? It's probably, wow, so much! Then when I tell you Microsoft earned over $40 billion, what's your initial reaction? It's also probably, wow, so much! So, how good would it be to be a shareholder of Amazon or Microsoft? Here's where earnings per share comes in useful. Earnings per share measure the interest of each ordinary share of an entity in the performance over the reporting period. It also improves performance comparison between different entities in the same reporting period and between different reporting periods for the same entity. Here's the formula for earnings per share. We take the net profit after tax minus preference share dividends divided by the weighted average number of ordinary shares outstanding during the period. The net profit after tax is simply the profit of the entity after deducting the tax expense. The preference share dividend figure used for computing the earnings per share depends on whether it is a cumulative or a non-cumulative preference share. If it is non-cumulative preference share, the figure used in the computation is the preference share dividends declared for the period. If it is a cumulative preference share, it will be the preference dividends for cumulative preference share required for the period, which is the dividend rate multiplied by the number of cumulative preference share. I want to make myself clear that for cumulative preference share, we will follow that formula regardless of whether dividends have been declared or whether the amount includes any preference dividends for cumulative preference share paid or declared during the current period in respect of previous periods. To illustrate what I mean, let's say the dividend rate is 5 cents per cumulative preference share, and there are 1 million cumulative preference shares. The preference share dividends used to compute the earnings per share is 1 million multiplied by 5 cents, $50,000. If dividends are not declared for the current period, will the answer change? No. If the directors declared $100,000 dividend to compensate for missed dividend in the previous period, what is the preference share dividend used to compute the earnings per share? It is still $50,000. We will ignore the dividends declared or paid to compensate for missed dividends in prior periods. Next, what do I mean when I say average number of ordinary shares? Sometimes a company may issue more share or withdraw some shares during the period. Let's say the company originally has 1 million shareholders and another 500,000 joined 1 month before year end. Is it reasonable to allocate the profit to 1.5 million shareholders? Does the shareholders who joined 1 month before year end deserve a full share of profit for the year? No. So we will use the average number of ordinary shares outstanding during the period to reflect the possibility that the amount of shareholders' capital varied during the period as a result of a larger or smaller number of shares being outstanding at any time. The average number of ordinary shares outstanding during the period is the number of ordinary shares outstanding at the beginning of the period, adjusted by the number of ordinary shares bought back or issued during the period, multiplied by a time weighing factor. The time weighing factor is the number of days that the shares are outstanding as a proportion of the total number of days in the period. We will go through a few examples to illustrate how that formula works. First, let's assume the company started with 8 million shares at the start of the year, and on 6 August, 37,000 shares were issued. So at year end, the company has 8,037,000 shares. 6 August to 31st December is 148 days. The formula for average number of ordinary shares is to take the beginning number of shares plus or minus changes in number of shares multiplied by the time weighing factor. So we will take 8 million plus 37,000 multiplied by the time weighing factor, which is 148 divided by 365. As the additional 37,000 shares were issued on 6 August, that means for the current year, the additional shareholders joined the company for only 148 days. For the purpose of this illustration, I'm assuming that this is not a leap year, meaning a 365 days year. That's why the time weighing factor is 148 divided by 365. So the average number of shares is 8,015,003. Next example, the company has 1,250,000 shares at the start of the year. On 27 May, 15,000 shares were withdrawn, giving it 1,235,000 shares at the end of the year. 27 May to 31st December is 219 days. So we will follow the formula again and take 1,250,000 minus 15,000 multiplied by the time weighing factor of 219 divided by 365, since the withdrawal of shares occurred on 27 May. And for the current year, the 15,000 shares were withdrawn for 219 days. That's why the time weighing factor is 219 divided by 365. This gives us an average number of 1,241,000 shares. FRS 33 paragraph 66 states that an entity will present the earnings per share in the income statement, usually below the net profit after tax line, like this. Please present the earnings per share in cents and round off the figure to 2 decimal places.